Guys, welcome to Co Academy. Guys, in this video, we'll be talking about three different methods where the cost of assets is allocated over the useful lives of the asset into the profit and loss account. The three methods are depreciation, amortization, and depletion. People often get confused about these three terminologies, and they don't know when to use which term. So in this video, I'll be talking about which method to use on which type of assets with examples. So first is depreciation. You often might have heard about this very often. So depreciation is when you buy an asset, let's suppose for $1,000, and you do not take that $1,000 into your profit and loss account in the year of purchase, because you are going to use that asset for, let's suppose, the next 10 years. So if the economic benefits from the usage of that asset are going to be received in the next 10 years, then you should also spread the cost of the asset in the next 10 years. So the useful life is 10 years, and you take the cost of the asset, that is $1,000, incrementally over the 10 years. For example, 1,000 divided by 10 equals to $100. So in each period you will take $100 into the profit and loss account as an expense. So depreciation is used for fixed assets, for example building and machinery, etc. Second is amortization. The principle is same, that is cost of the intangible asset. Okay, amortization is applicable to intangible asset. So the cost of the intangible asset is spread over the useful life of it. And when it's intangible assets as opposed to fixed assets, we call it amortization. For example, you purchased a patent. Okay, you are a pharmaceutical company, and you have invested lots of money in research and development, and you came up with a formula to treat a very very unique disease. Now you own the patent to that particular medicine. Now let's suppose that the regulatory authorities give you the permission that for the next 30 years only you can use that patent. Okay, no other company can use your formula, because you have put in lots and lots of money and resources into developing that formula. So for the next 30 year, you will whatever the cost you incurred upon that patent, for example if it was $30,000, then you will spread that over the next 30 years. Okay, so in this sort of allocation of cost to profit and loss account is called amortization. That is, whenever you spread the cost of the asset into the profit and loss account on intangibles, it is called amortization. The third is depletion. Depletion is when you spread the when, let's suppose that you are an oil drilling company and you bought an oil field. Okay, now of course it's a upfront capital expenditure. You have to incur lots and lots of expense to buy an oil field, but once again the revenue you will generate from using the oil, extracting the oil and selling it, will be realized over several years. So as per the matching principle in accounting, you will have to match the cost of the oil fields over the years in which you expect to receive the benefit. So let's suppose you assume that this well will last for the next 20 years, that if you extract oil from the well, it last for 20 years, and after 20 years there will be no more oil in the well. That is, the oil reserves in the well will deplete. So depletion, the word depletion is used for mineral assets, those assets which are consumables. Okay, which deplete. It's usually natural resources. So once again, you spread in depletion also, you spread the cost of the asset over the useful life of that particular mineral deposit. So the similarity is that all three methods allocate the cost of the assets over their useful life. But when it's fixed assets, you use the word depreciation. When it's intangible assets, you use the word amortization. And when it is depleting assets such as mineral deposits, oil wells, you use the word depletion. I hope this clarified your concept about the difference between the three, and how these three are related, and how these three are different. Thanks for watching, and do subscribe to the channel.